has reported earnings broadly in line with expectations, with pre-tax profits coming in at £1.1 billion. The bank is also reiterating its full-year guidance, and they had to take a charge for the mis-selling of a certain type of products to customers a while ago. But it was expected again. Our next guest, though, says that sovereign risk is driving 80% of share price moves in the banking sector. What is the best investment strategy as Europe's debt crisis seems to be spreading? Joining us now is Cormac Leech, a banks analyst from Canaccord Genuity. Am I pronouncing that right?
Yes, absolutely correct.
Okay. Cormac, I say it's super interesting because you've been quite specific in the way that you're approaching the banking sector at the moment.
Yes. Yeah, I think the key question for the sector right now is to basically answer the question, what is the probability of Eurozone breakup over the next 3 to 5 years? And as an equity analyst, I think the best way to trade the banks currently is to outsource that question to the fixed income market, specifically to the credit default swap market on sovereigns. So essentially what I recommend equity investors do that have a reasonably short-term focus or a dynamic focus to the market is to run regressions, multiple linear regressions of credit default swaps to the forward PEs on consensus earnings for the next 12 months for the likes of RBS, Barclays and Lloyds. And then based on those regressions, you apply a PE, an EPS and a fair value. And if you do that, you can stay out of trouble trading the banks based on CDS swaps.
Okay. I'm listening. I'm just wondering whether or not the CDS swaps are telling the real story, though, or how much of it is this VIX move of fear that's filtering into that trade as well, thereby skewing, I guess, how you would view banks.
Sure. I mean, I think that's very valid. If you look in 2008, the fixed income market massively overreacted to all of the issues. Having said that, I think it's very important to be very open-minded at the moment because I think the range of possible outcomes is huge. So, for example, if you ask sell-side equity analysts or market commentators right now, what's the probability of a Eurozone breakup? Many people, particularly people at work and potentially have vested interests, they will say 0 to 10% chance of a breakup, i.e. very low. Conversely, if you look at market prediction websites, where people actually put money behind their views, you find, for example, a 55% chance of a Eurozone breakup by the end of 2014. And just to define that more precisely, that's one or more countries leaving the Eurozone by, I think, midnight on the 31st of December 2014. That's trading at 55% right now. So there's a huge range of possible outcomes. And just to kind of map that across to the fundamentals, RBS has £44 billion of assets sitting in Ireland. A Eurozone exit by Ireland and a subsequent devaluation of, let's call it, the new punt, could see a 20 billion capital hit for RBS. So if you put that as a percentage of the current market cap, it's not difficult to come to a bearish conclusion.
Okay, Cormac, hi, this is Christine. It's interesting you mentioned RBS. I'm looking at your notes, and you mentioned also some safe haven plays, HSBC as well, Standard Chartered, some of the safe haven plays. Because of its exposure to Asia, is that why?
I think that's exactly right. I mean, many investors don't want to try and play the day-to-day moves and have a day trading stance. So I think for those types of investors, the safe haven plays are particularly Standard Chartered and also HSBC, where they have extremely strong capital ratios, very almost entirely emerging market Asian focused, where the macro profiles look extremely strong, the economy continues to boom, and perhaps for Standard Chartered the key question is their ROE going to stay around current levels or potentially edge up towards 15%? So the safe haven plays are HSBC and Standard Chartered. However, for braver souls who want to try and take a view on the macro risk in Ireland and in the Eurozone, I'm Irish, so I'm particularly focused on Ireland. For those types of investors, you can take a fundamental view on the Eurozone, or you can basically trade the banks off CDS spreads.
I would have guessed you were Irish on the slight accent, coming from someone with a wonky accent for some. You say there are two main scenarios for banks. We've kind of covered the bearish one. The bullish one, though, again, it's only bullish by the looks of things towards the UK banks.
No, actually. I mean, I think PIMCO's CIO Alarian framed the question really well. There are three ways to solve the crisis. One is a common European treasury. The second way is massive sovereign defaults such that the debt to GDP ratios come down to manageable levels. And the third way is that you have Eurozone exits and competitive devaluations by the struggling economies. So the first scenario, common European treasury, is very benign for the banks. If the politicians in Europe get their act together and actually manage to make that decision, then I would say all of the banks in Europe rally, I would say conservatively 20%, possibly 30-40%.
I'm just thinking, I will definitely post some of your thoughts on Twitter afterwards, and you have a Twitter account as well. We'll float that account for viewers. Just wondering, do you think that the Italian banks in particular are well capitalized, and are they strong, such as we've heard from a number of the Italian officials, especially, and the Eurozone officials here over the past couple of days?
I don't cover the Italian banks. However, this regression analysis I was referring to is very easy to just plug in any bank you want and spits out an answer. Whether you choose to give any weight to that answer or not is up to you. But for what it's worth, I did that about 2 weeks ago, and for example, for UniCredit, I think I got 98 cents per share, which I think is below the current level last time I looked.
Okay. Cormac, really interesting stuff. Thank you very much. Cormac Leech, a banks analyst at Canaccord Genuity, and as said, Cormac has a Twitter account, so you can find him on Twitter, or you can find me on Twitter at Louisa Boyerson, and I will post some of your comments after the show. A reminder as well that we do want to hear from you in general with any questions or comments that you might have on the debt crisis in Europe, whatever you have in mind, the yen intervention, where you should be placing your money. So find us, as said, either on worldwide at CNBC.com, on our email address, or on Twitter. Christine, loads of you already writing in. It's really interesting to see what people are thinking always, Christine.
Here in Asia, it's all about a yen intervention, of course, by the Japanese authorities today. It was a two-pronged approach. First, they intervened to